We're joined by Bob Parker, Senior Advisor at Credit Suisse. Bob, there's so much to talk about, but let's just get the Fed out of the way, because actually that's not going to impact the markets as much as it could have if we had more news of quantitative easing or anything like that.
Correct. I think the big decision for 2011 is when does the Fed actually reverse quantitative easing. Now, you've had a very clear statement from the Fed that that is not going to happen, I would argue, for at least the first quarter of next year, probably the second quarter of next year. But I think one thing we've got to watch for as a risk factor is probably as we go into the second half of next year, and as the US economy starts to accelerate towards 3% growth, then probably the Fed will start to reverse QE, and that could be a major risk for markets next year.
Until then, the major risk for markets is Europe. How concerned are you? It's normal that Moody's says we're watching this, we're possibly downgrading it. It's no real surprise, and yet it seems that the markets are reacting every single time.
Well, I think one trend which is going to go into at least the first quarter of next year is going to be further credit downgrades of the obvious countries under pressure. And I think there are a number of themes here. The first theme is that the growth differential between Germany and the rest of Northern Europe and the stressed economies, that is going to remain very wide indeed. And it's actually very difficult to see economies like Spain or Ireland, Greece, Portugal actually generate stronger growth, at least for most of next year, possibly going into 2012. So that growth differential is going to remain a problem.
But Bob, we have had some pretty good corporate news, despite all these, sovereign debt concerns. Are we going to see the sovereign debt concerns significantly impact equity markets in Europe?
Well, they have already, and I would argue that the sovereign debt concerns, actually markets are acting very rationally. And, if one looks, for example, at the performance of the Spanish and the Italian markets versus the German equity market this year, you've actually got an outperformance of Germany by close to 30%. Now, I think that underperformance by the stressed economies, their equity markets, I think at least for the first 6 months of next year, that underperformance continues.
And in terms of the sectors that you'd be staying away, is there anything that actually concerns you because it's so affected by the sovereign debt concerns, and actually we're just not seeing them grow?
Well, I think in economies like Spain, you need to focus actually on the companies which are actually generating their profits and their revenues outside Spain. And actually, if you look at large cap Spanish companies, they actually generate significant profits from Latin America. So your only exposure to the Spanish equity market actually should be an indirect exposure to Latin America.
Bob, when is it going to be a real problem, the sovereign debt concern? It seems that there's no way that this is going to go away. The leaders can't can't agree on this permanent mechanism, on how they're going to deal with it, Eurobonds or not to Eurobonds. What's going to be the resolution?
Well, I actually think there's a very significant political shift going on. And that political shift, which actually is in the interests, I think, of all governments, is that risk on sovereign debt is actually going to be transferred, or is in the process of being transferred, from taxpayers and governments to investors. And therefore, European bond markets, I think, are trading very differently today, and that big difference will continue at least for the next 2 or 3 years.
Yeah, interesting comments. Bob, thank you so much. Bob Parker there.